All right, everyone. Welcome into Tax Tuesday. It is, April 8th.
Yes.
Oh my gosh, this year's flying by. My name's Amanda Winalda. This is
Elliot Thomas.
We are both tax professionals here at Anderson Advisors, where you come to get tax knowledge, and we bring it to the masses. That's our tagline right there. Bringing tax knowledge to the masses.
And you're the masses.
Don't be rude, Elliot. All right, so the way that this works is that this is a live show. We can welcome everyone. Actually, let's give everyone a little bit more time to
Spool in.
Yeah, shuffle in. Why don't you give us a little shout out into the chat of where you're from? We always like to see who came from the furthest away, although you're mostly still just sitting in your homes usually.
Mm-hmm.
But who came from the furthest away? Go ahead and put up
Michigan,
in chat where you're
Detroit,
joining us from.
LA, Tampa, Vegas.
No, Detroit and Michigan are.
Texas, Napa.
A few people from Texas, Las Vegas. That's where we're located. We're at our Studio 210 in Las Vegas, Nevada.
Olympia, Jersey.
Central Coast, California. I just came from San Jose. We were in San Jose this weekend for a soccer tournament. My family's big on soccer, so I do a lot of traveling solely for the purpose. Wow. I'm unmuted now.
Well, it's been all good stuff so far.
But only Elliot could hear. Okay, let's start over. Welcome into Tax Tuesday, everyone. It is April 8th, 2025. The year is going crazy. My name's Amanda Winalda.
Elliot Thomas.
Which you already know because you could hear him because he wasn't on mute. All right, we've got everyone coming in. We've got a Maui.
That's a
Tijuana.
Oh.
Nice. Huntington Beach, California. Detroit, Michigan, Texas. Sometimes we get someone from overseas.
Yes.
We get a lot of questions from overseas in YouTube. So today we have a ton of tax professionals. Why don't you tell them who's joining us?
We got Patty running the show. We got Arash, Dutch, Jared, Jeffrey, Jennifer, Marie, Rachel, Ross, and Tanya. Let's see, we got one more down here at the end. And Troy.
Troy's going to be answering your questions on YouTube live in the chat there. That's pretty much where the wild ones are.
Yes.
Those of you who join us through the Zoom, not quite as wild.
Yeah, definitely.
But moving forward, we've got some preset questions, so we'll be going over those Q&A style. If you have questions with what we're talking about, or if they're completely unrelated, go ahead and put that into the Q&A. The Q&A, that's going to allow our team in the back to provide you with an answer that's going to be marked private so that nobody knows what you've asked or any of your details. If you're having any issues with sound or things like that, such as when I was on mute earlier.
Right, let us know.
That's going to go into the chat. So just two different things there. If you've got a question you want featured on Tax Tuesday, just email taxtuesday@andersonadvisors.com. And if you need a more detailed response, then you can become a Platinum client or a tax client. Anderson has this really great program called Platinum Membership. It is for a monthly fee, way less than it would cost to hire a CPA or an attorney to be at your beck and call. You can submit questions to our team and they can give you much more detailed answers. But if you'd like to be featured here, that's going to be taxtuesday@anderson.com. This is supposed to be fun.
It is.
Fast.
We have fun.
Educational. We do have fun.
Yes.
Taxes can be fun, everyone. Who knew? Who knew?
It is possible.
All right, we're going to go over just our questions and just reading through them. Elliot, why don't you take the first one?
Sure. I understand that you can sell your primary residence and receive an exclusion from capital gains taxes on the first $250,000 if you're single and $500,000 if you're married filing jointly. However, I can't find any rules regarding if you're married filing separately. I file separately because I don't want to add my husband's income as my student loans are calculated based on my AGI. Run into that quite a bit in tax prep, so you're certainly not the only one who does that. Well, could you please confirm if married filing separate also qualifies for the exclusion? Also, could you talk about how making improvements adds to the basis?
It's actually very common to be married filing separately, as we know, because we both paid a lot of money to go to law school.
Yeah.
All right. Can I use both cost segregation and bonus depreciation from an S-Corp you sell your personal residence to for the Section 121 exemption Also, what is the accounting treatment if you sold your personal residence to an S-Corp using an installment sale? We got a lot to dig into there. If none of that sounds familiar to you, don't worry. We will be explaining that strategy. Your turn.
Do I have to officially quit my job and be retired to take disbursements from my 401k? At what age can I take disbursements from my 401k? Are there any negative tax implications from taking early disbursements?
You got to do this.
Yes.
That's in the question.
Yeah, get the quotes
Right.
in there.
Some retirement plan question. What is the best entity for tax purposes to invest in real estate syndications? And this question, we're actually going to get into the legal side as well, because we're Anderson Advisors. We do tax and legal, so we're not just going to leave you hanging on one versus the other.
The two kind of walk together,
They do.
so we'll do that.
They hold hands.
Regarding bonus depreciation and the short-term rental loophole, that's STR for short, are either the 500 hours or 100 hours and more than anyone else material participation tests prorated for the year? For example, if a property is purchased and put into service in November, those hours would be difficult to achieve. So what? Well, we'll get into that more
They
depth.
sure would be.
Yep,
I think that might be the point, though, Elliot.
exactly.
If I purchased an investment apartment and repaired windows, floors, and incurred other miscellaneous expenses to make it ready for renters, can I write the expense off on my Schedule E? I didn't receive any income for that apartment as of yet. There's some details in that question that
Absolutely.
are going to change the answer a little.
I'm starting to do wholesale investments. Don't know what that is. We'll find out. I'm still a W-2 employee, yet I will resign soon. Is it recommended that I start my LLC now, and why?
Again, a tax and legal question. I have a trading account, but I do not actively trade in it. Should I set up a trading partnership for it?
Good question. And then we're going to review some of the expiring Tax Cut and Job Act items for 2025. As you may know, that was put into place in 2017, approximately September of 2017. Some of them are starting to come to an end. The whole thing comes to an end at the end of 26, but we have quite a few that are going to expire at the end of 25, and we're just going to hit some of those.
Yeah, we are. And then in a few months, we may be reversing what we say.
Exactly.
Congress can always reinstate them, extend them. We've gotten so used to talking about the way things are.
Yeah, I think they're a little busy right
They
now.
like to
but
keep us on our toes. It's fine, though. That's why we have jobs. All right, this is our founding partner, Toby Mathis. He's the reason you're here. If you're watching this on YouTube, then it's going to be on his channel. Smash that subscribe button. You'll get a notification whenever we go live for these Tax Tuesdays or when he uploads a new video.
And he's
A lot
over
of-
1,000 already.
I know, a lot of great stuff. He's got those cool YouTube awards. I mean, cool. Are they cool? I think they're cool. Putting a lot of information out
Cool,
there.
because he's our boss.
Yeah, he literally pays us to say stuff like that. All right, this guy's also our boss, Clint Coons, often known as the most handsome man in asset protection. We're not laughing at that.
Ken.
It's true. Ken, stop. Also, a huge educator, really big in this space. If you follow him as well, Clint and Toby were our founding partners, and they have similar videos, but Clint tends to go more on the legal side, Toby more on the tax side. Watching both of them is really going to give you a lot of what you need. This is our Tax and Asset Protection Workshop, or TAP, as we call it. You can come to a full Saturday webinar that gives you all of the basics on tax, asset protection. We usually have some pretty sweet deals on some services, usually the lowest prices that you can get out there. So register, go to our website, you can register. We also are doing a live event that's going to be in Las Vegas. So if you want to have a deductible business expense for your next trip to Vegas, come and join us. That's going to be at the end of June. All right. I understand that you can sell your primary residence and receive an exclusion from capital gains on the first $250,000 if you're single, $500 if married filing jointly. However, I can't find any rules regarding if you are married filing separately. This person files separately because they don't want to add their husband's income to their student loans, which are based on AGI. Can you please confirm if married filing separately also qualifies for the exclusion? Also, could you talk about how to make improvements on the basis? So let's back up. For those people who have never heard of the Section 121 exclusion, why don't you tell us what that is, Elliot?
Right. 121 is just that. It's an exclusion from capital gains of your from the sale of your primary residence. So, like anything in the code, it has some parameters, some guardrails.
Requirements.
Exactly. And so typically it's $250,000 if you're filing separately, but if you're married filing joint, you get $500,000. And so what we're asking here is, well, I don't do either. Well, we both file separately, both spouses. So do we both get $250,000? Is really what's going on, or would just one get $250,000? I think that's the nature of the question here, and we do have an answer for that. Yes. Yes, we can do that. Both spouses can get that $250,000, but we do. Let's go back to the actual requirements of 121 to begin with. Typically, you have to own it and use it as your primary residence for 2 of the last 5 years. They don't have to be consecutive years or anything like that, but it does have to be 2 of the last 5 years. Once we have that, if you sell it, then you're entitled to the exclusion if you have some gains. Now, if you had capital gains over the amount, let's say you're married filing joint, it was $500,000, and the sale is $550,000 capital gains, you'd still pay capital gains on $50,000 in that instance. However, here we are filing separate, and you pointed out something earlier.
I did.
Yes, yes, she did. And if we're filing separately, just one spouse has to have, is it the ownership or is it the use?
The ownership. So you would think that each spouse, if you're filing separately, separate tax returns, as long as each spouse qualifies on the 2 tests, the ownership and the use test, then they each get their $250,000. But they actually make it even easier for married couples filing separately, that only one spouse needs to own the property. So if you took title under only one spouse's name for maybe lending purposes, maybe one person's income was really good and another person's credit was really poor, so they're like, actually, we don't want you on the loan. That is very, very common. You're still going to qualify each of you for that $250,000, even though only one spouse's name is on title. And the same is true if you're filing jointly. Only one spouse needs to be on title, but you both need to use the residence as your primary residence. So if you're in a weird situation where we have clients where the husband lives in one state and the wife lives in another state, and husband-wife, because that's the example I can think of, which obviously isn't normal, but you wouldn't be able to qualify that way. You both have to use the property. 2 of the last 5 years.
Yep.
Unconsecutive.
Correct. So yes, we can use it in order to take advantage of the exclusion. What about the improvements? If we're making improvements, I guess we got to know what an improvement is.
We do need to know what an improvement is. What is it?
An improvement is just that. You improve the property. Now, it is...
Done. Next question.
Right? That's. I think you want to look at it as maybe a little bit more being put into it, like you put a new addition onto the house. Maybe you put new flooring in or new cabinets or something like that. Now, it's the U.S. tax code. There's things that you can, definitions that kind of vary and get into gray areas, but it's usually going to be something like that. If let's say you broke a window and you just replaced the window pane itself, probably not an improvement necessarily. Maybe that's more of a repair. But these improvements, things like, again, a new floor, new addition, new roof, things like that, that's going to add on. We're going to take that cost and add it onto your basis. What's your basis? It's what you originally purchased it for, okay? Plus improvements. And that number, what we call the adjusted basis, is what you're going to subtract from your sales price. That sales price minus adjusted basis gives us our gain, and that's what we're going to use this exclusion against.
Do you want to do an example?
Yes.
You throw out the numbers. I'll write them down.
Yeah, let's say that we bought for $200,000, and we made 50,000 improvements. We added some new flooring, some new cabinets, etc. New HVAC.
We just put in a alkaline reverse osmosis system.
There you go.
Because my teenager's like, the water tastes bad.
Go figure. In Vegas, what?
So that comes from Lake Mead,
right? All the atomic bombs we let off. All right, so that gives us an adjusted basis of $250,000, and let's say we sold for, I don't know, $800,000.
Okay, that's a good one.
So right now, we would take, Amanda's going to take the $250 away from the $800. That's going to give us, how's your math today? $515.
Tell me I knew what it was.
You sure about that?
That's your gain.
So that's our gain right now. If these taxpayers are married filing joint and they've lived there and used it 2 of the last 5 years, then they would be able to subtract that 500,000, and we end up with just 50,000 of capital gains. We didn't have to pay tax on $500,000. So it's a big benefit to having home ownership. It's one that we try and really protect using that strategy a lot with our clients. Depending on how we're gonna set up an entity maybe for a home, or if they're trying to do some funky stuff with the home, we want to make sure that we preserve that if at all possible, because it is a great tax advantage.
It's funny because we work with a lot of real estate investors, and they're trying to do the opposite with repairs versus improvements. They're trying to classify everything into the repair category so they can deduct it against the rental income. But in this case, you're going to want to try to classify as much as you can as an improvement. So maybe you break one window, maybe you just go ahead and put in
a whole new one.
A whole new set. And there's a lot of tax credits and things out there for energy efficient type stuff. So great thing to look into as well. All right. Can I use both cost segregation and bonus depreciation from an S-Corp you sell to your personal residence for the Section 121 exemption? Also, what is the accounting treatment of that installment sale? So we've just went over Section 121, so I think we're good on that. What is this whole situation with selling your personal residence to an S-Corp? Why would I do that?
Exactly. Well, just as you pointed out, some people have a lot of rental properties out there. A lot of our clients certainly do. Maybe they've been living in their primary residence and they're not ready to sell it. They don't really want to give it up. They want to use it as a rental. Is there any way we can take advantage of that golden opportunity, the 121, and still keep it as a rental? Yes, there is. We can sell to an S corporation that we own. And when we do that, we're going to incur that same capital gains calculation that Amanda just went through on the previous question. We had, 800 minus 250?
Did we do 850?
Yeah.
Now we don't know. Now we don't remember. It was 5 seconds ago, Elliot. So it was 250.
250 basis, yeah.
And so we had $50K in capital gains. Capital gains. But when we sell it over to the S-Corp, what are we doing? We're selling it for fair market value. Correct. So this 800 amount. So what is, when the property's in the S-Corp, what's the basis now?
It's going to be the new fair market value.
That new fair market value. Because it is going to be an actual sale. So you do need enough in this S-Corp. You need enough money in this S-Corp to put the 10% down, and then we're going to do what's called an installment sale, which for most investors, you'll recognize it really as seller financing, right? And then what's the important piece to making sure it works out for you on the tax side? You need to recognize.
Right. We can do an installment. However, because it's to a related party, which our S-Corp is, we have to recognize all the gain in the year of sale.
Yeah.
But that works well into our plan because we were able to wipe out $500,000 of that gain using 121. So therefore, this works really well. And just to step back, if we didn't do this and you just turned it into a rental and didn't sell it, didn't put it into an S-Corp or anything like that, the basis you'd be taking your depreciation from is a $250.
Yeah.
But by selling it to the S-Corp, Amanda was able to raise it all the way up to $800,000 for a new basis. So your depreciation is going to be a lot larger.
Okay. So what's depreciation? Depreciation on a single family rental means you take your basis, you back out the land because land doesn't lose value, and then you spread that out over 27 and a half years. It's 39 years for, oh my God, I'm sorry, my penmanship is terrible, for a commercial property. And so if your basis is 250, let's back out the land, just call it 200. You spread that over 27 and a half years. Do that math, Elliot.
Can't.
Now, with the cost segregation study, you have a specialized accounting firm come out. They can physically come out. You can do this over like FaceTime or a Zoom. They take a lot of info from the public record and they basically go, okay, you have an HVAC, you have windows, you have carpet, you have wood flooring, and they separate it out into a report that separates out each individual thing, the plumbing, the fixtures, into 5, 7, and 15, and 27 and a half year property.
Right.
15. And then you can take those on a shorter schedule. So if you paid, I want to come up with an easy one that we can do the math on. If you paid $1,000 for new flooring, you're depreciating that $1,000 only over 5 years instead of over the whole 27 and a half. So you're getting a larger depreciation there. Now, how does bonus depreciation work into that?
So bonus depreciation is going to take whatever amount you have of anything under class under 20 years. That's going to be the 15, the 7, and the 5-year property that Amanda was mentioning. And of that amount, you will have the current year annual depreciation, which is 5 years or 7 or 15. And then you'll be able to take an additional 40% here in 2025. So it becomes a much larger deduction. You already sped it up by taking the cost seg, so we're doing it over 5 years instead of 27, like Amanda was talking about. But now we're adding on coupling on something called bonus depreciation, which is going to take 40% of all those categories, the 5, 7, and 15, and we're just adding on that extra expense. It becomes quite a large expense, and can help us out a lot with our tax planning.
Yeah, it's a deduction. It's a paper deduction because it's not money actually coming out of your pocket, but it's reducing that taxable rental income that's coming in. 40%, it used to be better.
Yes, it was 100, and then slowly each year we're losing 20% of that. We're all waiting to see what the next tax bill will be. A lot of talk of it maybe being reinstalled.
Yep.
We don't know yet.
It has bipartisan support.
Now, important aspect to this though, because here we gave you all these definitions, gave you some calcs here, but we're selling to a related party, the S-Corp that this individual owns. And in that situation, we can do the cost segregation, we can speed that up, but we cannot do the bonus. That's a big
yes to the cost seg. No. So we just told them all of the benefits of bonus depreciation.
Yes, we did.
And they were like, you can't have it.
Right?
You can't have
Exactly.
it.
Took it away.
So you can do cost seg. So you're still accelerating the 5, 7, 15-year property, but you're not going to get to take the bonus depreciation.
Exactly right.
Now for what is the accounting treatment if you sold your personal residence to an S-Corp?
Let's call a friend.
Yeah, we're not bookkeepers. So we're gonna phone our friend Troy Butler. He's on our YouTube channel answering questions for y'all. But Troy was our head of bookkeeping for a very long time. He's one of our tax supervisors, so he reviews a lot of returns. Troy, are you out there?
I'm here.
Troy, can you walk us through the accounting treatment for this type of strategy?
So just so we're clear, I was answering questions on YouTube, so I wasn't 100% paying attention, but it's the installment sale on if you sold your house to your S-Corp, essentially, right?
Correct.
Yes, sir.
Okay, so what you would do is you would record on the S-Corp that is purchasing the home, you would record that as an asset. And then if you had, it would also have a liability, like a mortgage, right? For the note that's due to the original owner, you personally, right? So that's going to be an asset is your building and your land, and then you'll have a note for the installment sale. But you're not going to get to defer the gains, right? You're going to have to recognize the gains all at once, so we don't have to worry about that, which makes it easy. And then every month when you receive interest, that's going to be interest income. And then you're going to reduce the note by the principal payment that you receive each month. So each payment, you're going to have an interest portion, a principal portion, and then cash. So your debit would be cash, and then your credits would be interest income and interest expense.
All right.
Perfect.
Did you get that?
I did.
At least one of us did. Thank you, Troy,
Yes.
as always. All right. So that's how you do the accounting. And you said you have to recognize the gain, but you actually want to recognize the gain because that's how you combine that 121 exclusion. So you're getting that kind of double benefit there. Shh, don't tell the IRS.
Right.
Because they don't really like double benefits, but we found a way in this situation. All right. Do I have to officially quit my job and be retired to take disbursements from my 401k? At what age can I take disbursements? And are there any negative tax implications from taking early disbursements? So let's start with the first one.
Yep.
Well, let's start with the second one. At what age can you take disbursements from your 401k?
So under the rules, it would be 59 and a half typically is where you're going to be able to take out without any penalty. The penalty would be 10% of the amount that we're taking out. Mm-hmm. Like anything in the code, a lot of different exceptions and this and that and the other. But that's what the code says. Now, often when there's what the code says one can do, and then there's what the plan itself it says. So you always have to check your respective 401k plan to see what it allows and what it doesn't. But the code will allow you to start taking at 59.5 without incurring the penalties.
So no penalty, but you will pay income tax on non-Roth
Correct.
withdrawals.
Yeah, if you take your traditional, yes, exactly right.
Now, there is a way to take it out if you're 55.
Yeah, so we have something called the rule of 55. So there's certain things that are special occasions, if you will, that the IRS lets you go ahead and take it out earlier. Typically, if you say you left your job or you lost your job in the year you turned 55, then you can start taking disbursements without paying the penalty. There's some other ones like education.
Yeah, there's hardship withdrawals. So I have a whole list here. It needs to be an immediate and heavy financial need. Those are the terms. So medical expenses, certain medical expenses. If you're going to buy a home for you to live in, again, homesteads, where you live gets pretty special treatment in the tax code usually. Education expenses, costs and fees to prevent eviction or foreclosure. So it can even apply if you're renting your home. Funeral and other burial expenses. And then loss due or repairs needed due to federally declared disasters. So things like hurricanes, earthquakes, fires, things like that. It can't just be something bad happened. So we had a client who they lived in a rural area. Their only source of water was a well on their property. And that well, something happened and they needed to dig a new well. And man, we scoured the code to see if it could fall within this because the only way they could get the cash was to do a withdrawal from their 401k. And it just, because even though it was a repair to their primary residence, it didn't fall within a federally declared disaster area. So we ultimately determined that they wouldn't be able to qualify under a hardship deduction. But there are ways to get money out of a 401k, even if you're not 55 and a half, and even if you don't qualify for a hardship. What are some of those?
Right, and again, we have to look to your particular plan, but the code allows us to take a loan. You can take up to the lesser of 50%, or was it 50% or?
Of your vested shares.
Of your vested amount.
50,000.
Or 50,000, whichever is lower. So you got a plan, let's say you have 100,000 in there that's vested, you can take up to 50,000 as a loan, provided the plan allows it. And in this case, that individual could have taken out the loan up to 50,000. You do have to pay back, obviously, with interest.
Less interest.
And I think it's a 5-year period, I believe.
I believe so. It is a 5-year period.
So, and they're pretty tight on that. So you will start making payments right away.
But otherwise, you have to be retired to start taking distributions?
Don't have to necessarily be retired. Again, the code allows you to go ahead. If you're 59 and a half, you can start taking from the plan at the job you're at right now. But if you had a plan from a previous employer that's still over there, you technically should not be taking. Maybe some people do, but you're not supposed to. But you could take it at your present employer's plan if you're 59 and a half, if their plan allows it.
Yeah, so there's what the code allows and there's what your plan allows. You got to look at your particular plan. What's the tax consequences of taking these early? It says early disbursement, so we're going to assume this person's less than 59 and a half.
Right, so certainly we're going to pay, if it's just as a regular 401k, in other words, it wasn't a Roth, then we're going to pay income tax, ordinary rates on whatever that dollar amount we pull out. If we don't meet the age requirements, if we don't have these special conditions that Amanda went over, we're going to hit an extra 10% penalty on that, and that's going to be your tax consequence.
What about the Roth portion?
Right. If it's a Roth, well then typically you don't have any gain, taxable gain. That's the whole purpose behind the Roth. So you may still get hit with the penalty if we don't meet one of these conditions, but we wouldn't have the tax of ordinary income because it grows tax-free.
Yeah. And the same is true for the amounts you contribute.
Yes.
That you've already paid tax on.
Yeah, and usually I think you have to wait 5 years to let it settle, so to speak, is what they call in a Roth. But after that, then yeah, your contribution amounts are yours, and you can take those out.
All right. Very thorough, Elliot. Thank you.
Yeah.
What is the best entity for tax purposes to invest in real estate syndication? So I'm going to ignore the words between the comma, and we're going to start off with the legal implications. And so we With a real estate syndication, you're typically investing as a limited partner. So the limited partnership owns the asset. You as a limited partner have limited liability. That's what it means to be a limited partner. So from a legal side, you don't have really a ton of risk out there.
Correct.
Your risk is up to the amount of your investment. So if that limited partnership, if that syndication is sued, you put in $100,000, you could potentially lose that $100,000, but you're not going to have any other type of personal liability there. That being said, we do still generally recommend that you hold limited partnership interest through a Wyoming holding company. It just gives you a little more anonymity there. If that limited partnership sued and that gives them a list of all the limited partners, you're seeing an anonymous LLC there. So that's going to be either your main holding company, or often clients will set up a separate holding company called a Safe Assets LLC, and that's going to hold things like your syndication interests, your cash, your brokerage accounts that you're not actively trading in, all of those things that don't have a lot of liability coming to them. So on the tax side, Elliot, what is the best type of entity for this investment?
Well, we do really work hand in hand with the law on here. And so as Amanda pointed out, we're going to look at those types of, maybe a disregard LLC to put it in, because that's going to flow directly to our 1040, which we like, because this is real estate. For those who don't know what a real estate syndication is, it's just a large group of investors typically getting into the investment. You may have a general partner out there, but most of the investors are all limited partners, as we pointed out earlier. We want all that activity hitting our personal return usually, because they're going to do some of those things that we talked about. Cost segregation, bonus depreciation can create a lot of losses that might be in our favor. You like to have that hit your 1040 return for various reasons. So we're typically going to see it in that type of maybe a disregarded LLC, maybe a partnership if you're married and you and your spouse are on the partnership, we could put it there too.
Mm-hmm. And that's going to, if you have other passive income coming through from other rentals, then those losses are going to typically offset that. So you're paying less tax overall. What about holding it in an S-Corp? Why would we not do that?
Well, I don't know that there's any reason that you couldn't, but first of all, an S corporation will be an additional return. And you do have different concerns with an S corporation. Perhaps you might run into a reasonable wage requirement if you have a lot of income coming in there. And there we've gone the wrong direction. If we have to pay a reasonable wage, we're adding to our tax burden, because it's not just going to be ordinary tax, it's going to be additional employment tax on that. So there's quite a few reasons why we typically would shy away from an S corporation. We don't like to put any kind of really real estate in there unless we're flipping or something like that, which is not what we're doing here. So usually, yeah, your disregard or your partnership.
I like S-Corps more for active businesses where you're working it. What about a C-Corp? Why would I not put my syndication in my C-Corp?
Again, I don't know if there's no rule out there that you can't, but maybe we won't want to. Right, no. Because if we have, eventually, if let's say you were going to use those losses, that is from the cost segregation, bonus depreciation that we talked about, that often these cost segs do, that's going to be stuck off on a different island. It's going to be on a different tax return as a C corporation.
Island.
Exactly. It's never going to hit 1040 island, which we need it. And then when they ever sell it, the benefits, all that will stay in the C corporation. Let's say you have a large gain there. How are you going to get it out? I mean, there are things to get some of it out, but if we're talking about a large amount of money, in a sense, it could be trapped there. How are you going to reinvest it? And so you have a lot of different considerations if we're going to use that C corporation.
All right. So best entity for tax purposes, it's going to be a disregarded LLC, typically going to be set up in Wyoming or another anonymous state, or partnership if you're married.
And we talked about the passive aspect. There's also a lot of our clients are beyond that. They are what we call real estate professionals.
That's true.
It's no longer passive. And now it's active. All the more reason you'd want something that's going to hit your 1040 and typically not get it messed up in a corporation.
Yeah, we want those active losses. All right, regarding bonus depreciation, which we talked a little bit about already, and the short-term rental loophole, STR, short-term rental, are either the 500 hours or 100 hours and more than anyone else material participation test prorated for the year. For example, if a property is purchased and put into service in November, those hours would be difficult to achieve. Yes, they would, and that's kind of the
That's the
point.
point, right? It's
So let's talk about what is the short-term rental loophole first of all. Well, first of all, because if you haven't heard of it, you may not understand any of the other words in that sentence.
Yep. The STR stands for short-term rental. And what we're saying here is we got a different type of rental. We all are familiar typically, well, I rented out an apartment or something like that for a year-long lease. That's long-term. That's the normal condition you usually see. But there's things such as Airbnb where we have a shorter period of time, usually 7 days or less average stay. And that has a total different type of tax treatment if we do something like that. There it becomes a trader business. It's like a hotel you're operating, not classified as long-term rental property. So we have two different categories going on there. What the short-term rental loophole is that it's theoretically at least easier to not make it, or to get it out of the passive realm. Any business out there, any trader business that you get into, you have to materially participate in if you're going to have it as non-passive income or losses. So here, short-term rental loophole, we refer to it as a loophole because you can have a rental type property, even though it's short-term, Airbnb. It's a lot easier to meet that standard of material participation for the short-term rental, which is going to make it non-passive or what we call active losses, and you'll be able to offset any income on your return with those losses. That's why they call it the loophole. But we have to meet a material participation status, and there's 7 different ones, but there's 2 or 3 that we typically deal with more frequently. The 500 hours or 100 hours or more than anyone else, that just says you're putting more time in than anyone else. Those are the 2 that we primarily see. There is another one that kind of fits into play here. We're in November. First of all, I'll answer the question, I guess. Do we prorate? No, we don't. You got to get that 500 hours or meet the 100 hours or more than anybody else between November and December 31st. But there is the other test number 2, and that is your activity substantially constituted all participation. In other words, Amanda did everything. She ran the thing, she marketed the thing, she cleaned.
Maybe I didn't do 100 hours,
Right.
but I did most of it.
Yeah, she did substantially everything. She's going to get material participation under that test, which we don't have listed here. And that would be my guess that that's the test they want to try and go for in November. But remember, they got to be the one doing everything. You can't really have other people coming in and cleaning or anything like that.
Yeah, and that's really the big kind of chink in this strategy is that if you don't live close to the property and you've got to hire someone to come in and clean, you got to really rotate those cleaners in. Because remember, if you're going to meet the 100 hours and more than anyone else, nobody else can do more than you, right? So if it's the same, if they're cleaners, different cleaning crews from one company, that's going to be considered one place. So you may have to rotate through different companies. A lot of our clients will actually wait until the 3rd quarter of the year to implement that strategy. You'd be surprised how quickly you rack up 100 hours when self-managing a rental, especially a short-term rental. And because they don't want to give another third party the opportunity to rack up as many hours, maybe they're only having the property available for rent a quarter or half of the year, and then there's no danger of that. So what type of hours actually qualify as material participation? Obviously, anything that's day-to-day management, which is pretty, I don't want to say it's easy. The whole idea is that you're putting in enough work that the code is now treating you as active in that activity. So when you're generating losses, which is the point of this strategy through cost seg, bonus depreciation, those active losses now offset your W-2 salary. So lowering your overall taxable income. So you do have to put in a lot of hours. It's fairly easy to do once you've got it set up with all of the apps and the automations and things like that. You do still have to like communicate with the renters who sometimes always have problems. You know the type. But does looking for the property, does furnishing the property, do those hours count as well, Elliot?
They do. I mean, we have to, but we don't want to abuse it. So the example we were kind of batting around, well, what if you went and looked at 20 properties in one weekend? You know, are you going to take all that time, and let's say it took 20 hours, are you going to use all that time? No. And how are you going to really show that that time was dedicated to that one property? You know, that's going to be very difficult. It's not Amanda and Elliot you have to convince, it's the IRS.
It's not us.
Right, exactly. So if you can isolate I went back to that property the next weekend, the time I spent doing that to acquire that property, get it purchased, then I think you have a very strong argument for using those hours. Then any renovation that you did hands-on will typically count. It gets a little bit messier if you're just kind of observing and overseeing it.
Yeah, you can't count the hours where you're scheduling contractors, things like that. But the IRS is fairly savvy. I mean, these types, the material participation tests, rep status, short-term rental loophole, they're pretty highly litigated compared to like topics in tax. And so there's quite a few cases out there. There's one in particular, Hairston. It was a couple who very clearly needed 40 more hours to hit that material participation test, and they didn't have it. So they just threw down at the bottom of their log 40 hours supervising the painters. And the court got a little bit cheeky and said, we understand Mr. Hairston, having recently retired, had a lot of time on his hands, but we simply don't believe he spent 40 hours watching paint dry. And so the court knows when you're just trying to pad your log, and they know when you've really been doing it. So definitely list the hours that you are doing something, but if you're not actually painting, you don't want to list the entire time the painters are there. Even if you do, just sit there in a lawn chair with the margarita watching them work.
Watch that paint.
If it's in a nice resort area, that could be a good use of your time, but you're not going to count all those hours. So log everything and then put the onus on the IRS if in the small chance of an event that you got audited to disprove your hours.
Yeah. But yeah, those are, again, hours outside of just the direct management of it. Again, acquisition, renovation time spent, kind of hands-on type stuff is certainly time that we could probably throw on there. But you really want to get the bulk of it in your management because it's very difficult for them to argue against that.
Yeah. We turned our old personal residence not into a short-term rental, but a furnished like 30-plus day rental because that's what you're allowed to do in Vegas without a permit. And it took my mom, my dad, me, my sister-in-law, and my brother an entire 3 days to like clean it and get it set and do all the shopping to furnish like all new. You need a little few extra appliances because obviously we were taking our appliances with us to our new house. Sure. Furnish it. If you're building the furniture, you can count that. But if you're really doing the work, that 100 hours is easier to hit than you would think.
Yeah.
All right. If I purchased an investment apartment and repaired windows, floors, and incurred other miscellaneous expenses to make it ready for renters, can I write off the expense on my Schedule E? I didn't receive any income for the apartment as of yet. So this goes back to our question earlier, kind of the reverse of improvements and expenses for your personal residence on a rental property. What can we write off in the year and what do we have to add to basis?
Right. So just any expense, for repairs are going to be something where you're just trying to bring it back to its original condition. Elliot broke a door handle on something.
He does that.
Right, especially on my place. And you put a new door in there, that's kind of a repair. You're going to be typically able to go ahead and deduct that in full. Again, broken window, that's always a popular one in my neighborhood. New carpet or something like that. These are all...
get you out of there.
Right, exactly. New floors, well, certainly you can, yes, those are expenses that you'll get a deduct in some form. New light bulbs.
What is the $2,500 safe harbor rule?
So we do have another provision that even if it looks like those were repairs. We have other things that are more significant, like you added on a whole new addition. We call those improvements, which we're going to have to depreciate typically and not expense. Well, what's the de minimis rule that you're referring to? If you buy something that would typically be depreciated over time, if it's under $2,500 and you got the receipt for that one purchase there, you can go ahead and expense it. The IRS doesn't care. So you could get a washer, dryer set for under $2,500. You get a new refrigerator. If you have separate receipts for them showing the purchase and those respective purchases were under $2,500, go ahead and expense it right away.
Yeah, so basically anything $2,500 or less, we can classify as a repair. Anything above, we really have to look at whether it's a repair or a capital improvement.
Correct. Repairs
we're deducting in this tax year, so we're getting the tax benefit now. Capital improvements, we're depreciating over time, so we're getting a smaller benefit over time. All right, so now the nuance in this question is these are all expenses incurred to make it ready for renters, meaning that there were no renters in that. So we kind of have to look at the rules for, can you take expenses before it's actually even a rental property?
You can't until you place it into service.
What does placing it into service mean, Elliot?
Right, it just begs that question. Generally, that just means that it's available for rent. And again, you ask what that is. Well, if you just happen to have a property and you're ready to rent it, if someone comes up to it, well then it's technically it's available for rent. But usually we evidence that by going ahead and putting it out there on the market, in some kind of advertising venue. That would usually be the day that you call it available for rent.
What if you listed it, but nobody could actually move in because the floors were pulled up?
Well, then you got possible legal problems if someone goes in there and they trip or fall. So you definitely want your asset protection. If it's going to be condemned, you got all kinds of problems. You could still be making repairs, have it available for rent. People out there, and you could get by with that. I think at some point though, the balance tips a little bit where it's not practical that it's actually available for rent. It's not safe. But if it's a minor repair we're doing, maybe a gutter or something like that, I think then we're okay.
So you can't really get around the put into service requirement by simply just throwing an ad up on Craigslist or Zillow. It has to really be available to rent. So if it's not in service, you can't take those expenses, even if they are smaller repairs. You add those into basis then.
That's right, and then we'll depreciate it.
You add that doorknob into the basis.
Exactly, yep. And the window.
And the window.
And the dead plants.
So secondarily, let's say the apartment was available to rent and you've made these repairs, but you didn't make any income because for whatever reason no one rented it. Can you still take those expenses then?
Absolutely. There's no income requirement. You don't have to be making money for it to be a trade or business, and yes, you'd be able to take the expenses.
And that would just show up as a loss on your Schedule E. Passive loss if you don't materially participate, which would offset any other passive gain you had. So if you had extra income from another rental property, those two things would offset each other. If not, that loss accumulates as a passive activity loss, PALS.
Yes, it does.
Until when?
Until we either substantially sell all of our property, or we sell the unit that's creating the losses. Typically that will, or if you sold some other property, it could suck up those passive losses as well. But it's going to be the selling typically of the structure.
Yeah, so even if you can't use those losses, you get to still keep them, and that's going to help you in the sell the property eventually. There. All right, another shameless plug for our tax and asset protection workshop, April 12th and April 19th. It's a one-day webinar just like this. You come on into a Zoom. We've got tax and legal professionals in the background. You can ask questions about what we're teaching, or you can ask questions totally unrelated, which we do get a lot of. I believe the last webinar last weekend, they asked over 1,000 questions.
Oof.
Whew. We have extra workers' comp for the carpal tunnel that our team gets. So sign up for those, register now. Those are completely free. And then our June live tax and asset protection workshop is going to be here in the lovely Las Vegas. Tax deductible business trip.
Fabulous.
Not the gambling part. But the hotel, the travel, all of that stuff. Register now, buy tickets. Tickets are pretty cheap for that. Well worth it. And then if you don't want to come see us or watch us and you're ready to schedule a free strategy session, check out this QR code. You'll get matched up with one of our business advisors, senior strategists. Last tax and asset protection event we did a couple weeks ago in Dallas, I did the math and we had over 450 years of tax and asset protection experience in the one room.
Wow.
So you're going to get matched up with one of those lovely people, and you're going to be able to talk about your personal situation, what your goals are, what your aspirations are, what your worries are, and we're going to be able to build you a structure to protect your assets, save you on tax, and really build a legacy.
Yes.
Build that legacy out. All right. I'm starting to do wholesale investments. I'm still a W-2 employee, yet I will resign soon. That is the spirit. It is recommended that I start my LLC now, and why? So what's wholesaling for those of our audience who are not real estate investors?
So wholesaling is you go out, you find a property, you get it under contract, but you haven't really closed yet, so you don't really own it yet. And you're really just trying to unload that contract as quickly as you got it. You can do that by signing the contract or maybe doing a double closing. little bit more dicey there, but certainly it's something that can be done. And what we've done now is basically moved it from the seller over to the new buyer, and you acted as the middleman, as the wholesaler.
And you're usually charging a fee for that.
Yes, absolutely.
You're doing the legwork for the investor who is eventually going to turn it into a rental, maybe flip it, things like that. But if you've heard the term driving for dollars,
Yes.
driving for dollars, when you just pop in your favorite CD and you drive around looking for those properties that look a little wear and tear, a little like they haven't been taken care of, walk up to the door, knock and say,
No
hey,
doorknob.
no doorknob, maybe. Hey, would you be willing to sell your property, typically for a reduced rate, so that every person along the line is getting a good deal? Wholesaling, if we're talking about active versus passive income, it's going to be active income, just like 1099, just like W-2. Active is by the sweat of your brow.
Yes.
If you're driving for dollars and marching up to people's doors, you're definitely sweating in some localities.
Definitely in Vegas.
Definitely in
In the
Vegas.
summertime. But it's going to be ordinary income. You're going to get hit with extra employment tax. So yeah, we're adding on the tax. There's no question about it. And when we do the wholesaling type investment strategy, I think that leads into our next part about the LLC. Any thoughts on that? What are you thinking?
Yeah, from the legal side, you definitely want to do this in an LLC. If you think about it, you're entering into contractual agreements with the seller, also with the end buyer. And if something goes wrong with that, maybe the end buyer defaults and then you're stuck holding the bag. You don't want to be personally holding that bag. You want your LLC to be holding that bag. Worst case scenario, the LLC is sued to enforce the contract. It has no assets to enforce that contract under. So you definitely want to be doing wholesaling through an LLC. You typically do a state-specific LLC. So if you're doing it in Nevada LLC, you're the manager, the member of that. You're still signing everything, but in your capacity as the manager, not as the actual person doing the wholesale. So that's going to give you some legal liability protection. And then on the tax side, disregarded, probably to start. I would start just disregarded.
And yes, because if you don't know if you're going to hold it or not, sometimes what happens, we get in these situations and they want to hold the property. So I'm with Amanda. I wouldn't be opposed to having it disregarded until you knew that you're going to do that double closing, or that you were able to assign that contract over to the new buyer. But once we know that that's kind of going to happen, we probably want to go to a corporate structure, S-Corp or C-Corp, make that election on that disregarded LLC. Why? Because it can help us save. We got time then to get reimbursements and deductions against that income, get a lot of money back to you tax-free. If it's an S-Corporation, we might be able to save on more employment tax. So a lot of tax goodies happen there. But every now and then you do end up renting that property instead of getting rid of it. So we don't really like to have those incorporations.
Definitely.
Yeah, so I
mean, wholesaling is just like any active service-based business to me. If you start out as disregarded LLC, until you know kind of how much you're going to make. If you're making maybe 30, 50, that's when you make the S election. If you get a property under contract and you end up having to close on it yourself, you can always assign that contract to your other LLC that's going to hold the passive rental property. You don't want to hold long-term capital assets in that S corporation.
Correct.
So you want to eventually close if you're keeping it in a separate entity.
Yeah, and if we'd started out at the S, which isn't the worst, and then you held the property, well, then it is the worst because it's very difficult to ever get back out. So I'm with Amanda. If you can kind of hold off, buy some time and keep it disregarded until you know that you're ready to close, then make that election.
What point in the tax year do you have to make that election?
For an S corporation, what the code will tell you is, if you're starting at the beginning of the year, it had to be by March 15th day of the third month. However, if we're starting and setting up the business in June, well, then again, it would be 15th.
You can't go back in time and make an S election, can you?
Well, we can do late election sometimes, and the IRS has been very generous, usually on granting those, as long as you ran the business as an S corporation. What does that mean? We're paying payroll, reasonable wage and things of that nature, and showing that it was run as an S corporation, then typically you could make late election up to the date that you started that, in my case in June, you wouldn't be able to go back to June or January 1st because it didn't exist, the LC. So you can do that. The C corporation is a little more challenging. It's not that they can't go back, but we don't see it as frequently. I think it's really the S corporation we'd play that game with.
Nice. All right. I have a trading account, but I do not actively trade in it. Should I set up a trading partnership for it?
This is a great question because we do have a lot of ways for, it's kind of built on asset protection first. We want to, there's no point in having a brokerage account if Elliott sues you, if it's just in your name and I take it away from you. So we want to get it into a box, maybe an LLC that's a Wyoming LLC for safe assets. If we're not doing a lot of active trading, if it's just sitting there, just go ahead and put it in there, no big deal. You don't need to go through more formal structuring really than that. But if you are starting to actively trade a little bit more, then it may behoove us to go ahead and put it into a partnership. We often set that up. We always talk about, but let's draw it out here.
Yeah, what does this look like? What type of entity is this?
Yeah, it's going to be an LLC taxed as a partnership.
Or a limited partnership.
Excuse me, yes, or limited partnership.
Or an LP, and then the limited partner is going to be?
The individual.
You.
Yep.
And then the general partner?
Going to be a C corporation.
It's going to be another entity, a C Corp. Why are we doing that?
So by doing this structure, let me just start with what happens if we didn't do this. If we had $100 a gain and we didn't do any of this structuring, it's going to hit $100 a gain on our 1040. But by merely doing what Amanda's drawn up here, and let's say the C Corp owns 10%, the individual owns the other 90, and we have that same $100, right there we've automatically taken $10 off of our 1040. We don't have to pay any tax on it. It goes to the C Corp. Certainly the C Corp, if we didn't do anything else, would have to pay tax on it at a flat 21%. But that's the trick. The C Corporation has a lot of reimbursements and benefits that can get that $10 back to us tax-free, while it's a deduction to the C Corporation at the same time. So it would be very possible to zero out all income here in the C Corporation so we have no taxable income, and the individual ends up pocketing that $10 without any tax on it.
Yeah, so we take things out for like 280A meetings, 105B plan, medical reimbursements if you've got high medical expenses, just normal accounting plan stuff, and then that all gets reimbursed back to the individual, and it's completely tax-free. So you've shifted income off of your personal return onto a C Corp return, immediately reimbursed yourself back in your pocket tax-free. So what types of expenses are we able to deduct from the C Corp?
We can special allocate some of the expenses that you would ordinarily not be able to deduct. When we came out with the Tax Cut and Jobs Act, we really lost the ability to deduct a lot of that. It was under what we call a miscellaneous 2% rule under Schedule A, or itemized deductions. So you had to be itemizing to begin with. And then you have to incur these expenses in excess, and you could only deduct the amounts that are in excess of 2% of your AGI. So it was really limited.
And they're limited even more now because that went away completely.
Yes, exactly. Yeah, right, exactly. So nothing at all. So that's one reason we like this structure. And it just, but really if you weren't doing the active trading, which was the call of the question here originally, then you could just set up the,
just
disregard
a
it,
safe
just the
asset.
box.
Wyoming LLC, just disregarded to you personally. If you're married and not in a community property state, you might need it to be a partnership there. But if you're incurring higher fees or account maintenance fees, or you're doing a lot of trades, incurring fees for options or trading on margin, then you're going to want to do this LP structure and shift some of that income, because you can take those expenses on the C Corp. You can't take them on your 1040. All right, that kind of rolls into this last question, which are some of the expiring Tax Cuts and Jobs Act items for 2025. So that limitation of not being able to deduct those, what is it, miscellaneous itemized business expenses, subject to 2% floor, that's going to go away.
Yes. Yeah, so with that, we got a whole bunch of things that are really going to change. First of all, individual income tax brackets. They're going to be high. It's going to be less favorable to the taxpayer. They lowered a lot of the brackets for a lot of different groups, and even the overall cap, I was thinking was 39%, 39.6 was lowered to 37. So everybody's going to pay more tax if these expire. including the middle class and the
It was 10% was the lowest tax bracket, and then all of the other tax brackets dropped down by like 2%. So at the end of 2025,
yes.
if this isn't renewed, then they'll all bump back up. So you may be looking at a higher tax bill there. The standard deduction.
Big changes there. We'll go back to the way it used to be. And right now, they just made a very large standard deduction we've been living with for the Tax Cut and Job Act years. But it would go back to about $8,350, they think.
Yeah, they basically doubled it.
Yes, they did. Yeah. And they took away personal exemptions, and that was kind of the trade-off. But if it expires, we'd go back to the old standard deductions, and we would go back to having personal exemptions. I did some quick math here. You know, if that happens, basically a married couple, you're looking at about $23,700 that you would now be able to take if it expires. Whereas at this moment, without the expiration, you'd be able to take about $30,000. So another bite there, less tax.
Significant.
Yeah. It really all adds up because remember, you're at higher tax brackets. You get less of a standard deduction / personal exemption deduction. So you're already, several $1,000s of more taxable income.
It also makes your taxes harder to report, and you got to keep track of more. Right now, with the standard deduction doubled, most people aren't even paying attention to what they're paying for medical expenses because they know they're going to take the standard deduction. They're not paying attention to what they're doing for really anything that you deduct on your Schedule A because that standard deduction is so high right now comparative to what it used to be. So if it does go back down, you've got high medical, if you do a lot of charitable giving, you may actually be able to get more of a benefit there by itemizing, but you are going to have a lot more to keep track of during the tax year.
No question. Child tax credit.
Child tax credit.
And that's going to drop, they estimate, by 1,000. Down from 2,000. The phase outs, the dollar amounts are going to be lower, so less tax credit basically for the children all the way around.
They're taking the tax credit from the children.
Yeah. I know.
For the children. So more people that are in higher income tax brackets are not going to have this available to them.
Correct.
It phases out, and then on top of that, it's half the amount it was going to be. Man, that's not good. I got a lot of kids, so.
Now, some good news, maybe one might say, is that if we went back to this, we'll have it'll be more likely that you're itemizing. That's our Schedule A. And that's what Amanda was referring to earlier. But the SALT limitations, the state and local tax.
It's going to be removed.
Yes, and that was one of the biggest things. I remember when this first happened in 2017, all the calls.
California and New York are not happy.
I had more calls from you guys on the East and West Coast, from Massachusetts and from California. Some lost, I can't even
Tens
say,
of
$90,000 plus of deduction. And
so the rule is now you can't deduct more than $10,000 of state and local taxes that you pay. So that's including your state income tax. That's including your property tax.
Yep.
So if you're in those places with high property tax, high income tax, the max amount you can take as a deduction if you itemize is $10,000 now. So as you can imagine, that can be
Pretty
2-3 times more.
Yes.
So that could be a benefit for you in those high property tax and income tax states when that sunsets.
Yeah.
Sunsets. Okay, mortgage interest deduction.
Yes. That was originally $1 million that you could take. So that is if you're on your, yep.
That's the kids say mid when it's like just so, it's mid. It's the mortgage interest deduction though.
That is $1 million that you could take your mortgage on your primary residence up to, that is the loan, the mortgage amount is $1 million. You could take the interest up to $1 million. The interest against $1 million loan, they dropped that down to $750,000. So that would be one, I guess, bonus. They'd be raising it from $750,000 to $1 million.
If you've got $1 million mortgage, which again, most of the country, I mean, property prices have gone up, but
yeah, not mine.
sounds like a coastal city problem,
right?
Which I am from California, so I sympathize with you.
Yes, absolutely.
Don't move to Nevada, please. Thank you. All right, medical expense deduction.
Amanda stirring the pot.
I know. Gotta generate what's it called? Engagement.
Right.
Medical expense
Get
deduction.
the energy going here, good or bad. It's energy. Yes. So this is
So the Tax Cuts and Jobs Act initially lowered the floor.
Yes, to 7.5. It was 10%. So I guess.
What does a floor mean?
Yeah,
Elliot?
good point. So this is 7. First of all, we have to be itemizing, okay? So we have to get into Schedule A to begin with. That means that all of our deductions are exceeding those standard deductions that we were talking about earlier. Now, once there, you could deduct your out-of-pocket medical expenses if they exceed a floor that is 10% of your adjusted gross income. That's how it used to be. So you would, let's say you had 100,000 AGI, 10% of that, $10,000. That means that you have to spend $10,000 on your out-of-pocket meds, right? Before you can deduct the first dollar on your Schedule A. So they lowered that down to 7.5%. That would be removed, and so in that case, you'd only have to spend up to $7,500 before you got your first deduction. That would be a $2,500 difference, obviously.
Still pretty high, though.
It is. Yeah.
Even in all the tax returns I reviewed, rarely did I see anyone getting any benefit from that medical expense deduction.
It really calls for then maybe trying to get an HSA, health savings account or something like that, or maybe run the C corporation with medical reimbursements. Amanda had shown that earlier. So
For as high as those medical expenses are these days.
Correct.
All right. So the miscellaneous itemized deductions subject to the 2% floor, that's what we were talking about earlier. So same idea. You can only deduct these expenses if they exceeded 2% of your adjusted gross income. That will go away completely at the end of the year. Okay, QBI.
I love this one. Qualified business income deduction. This is commonly called, most people refer to it, when I'm talking to clients, the 20% deduction. It's a little more complicated than that. Of course, it always is in the code. But basically, if you have a sole proprietorship, if you had any kind of business structure other than a C-Corp, okay, you're entitled to this generally. And so if you had $100,000 income, you get to deduct 20% off of that. Obviously, there's some nooks and crannies to that, but that's the general rule.
Nooks and crannies.
Yep.
English muffins.
Right? So that, but that would be going away, and we'd be back to none of that deduction.
Yeah,
So,
you get nothing.
yeah, exactly.
Got zero. That's going to hurt small businesses, medium-sized
You get
businesses.
nothing and
a
you
lot.
enjoy it.
You'll take it and you'll like it.
Yes.
Estate and gift tax provisions. So the Tax Cuts and Jobs Act increased the exemption. So the exemption is the amount in your taxable estate once you pass away that is not subject to estate taxes. Estate taxes can be 40%. 40%.
Brutally high, and they grow up fast. Yeah.
And so the amount it currently is
14 million right now. It was approximately 12 when they started. It's
per
gone up.
person.
Yes. So we can double that. Basically 14 times 2.
Yeah.
What do we get for that? 28?
Don't ask us. Don't ask us to do the math.
That's a lot.
You get a lot.
And otherwise it's going to go expire and go down to 5 million.
Yeah.
Yeah.
My uncle is always saying, it's a good year to die.
It is.
Please don't. But
Right.
depending on how this goes, maybe you're in that same boat.
Yeah.
Please don't, though. Please don't. We like
given-
having you around.
But given the choice,
All right. Business tax. So interest expense deduction limits.
Oh, yes. Okay. So
We're like, let's read it for a second.
yeah, the ATI. I got to look at this one. Yeah, okay, yeah, this was the overall limit on the amount of tax that you could have against interest. That is interest expense. It was 30% of an adjustable taxable amount. That's due to expire. So it looks like they say if it does, it'll become more stricter. So in other words, what was going on?
More strict.
Yeah, more strict. Well, they just reading from our notes here. But it's going to be more strict. Right now, you can deduct 30% of your business interest, and they probably, if that goes away, it'll be less favorable than that. I honestly can't remember off the top of my head what it had been before. It's been so long, 2017.
Yeah. It was probably bad.
This is right. Yeah, this is the next one's probably the huge one. I think that everybody's really kind of looking at, and that's the bonus depreciation. And as we talked about, alluded to a lot, it used to be 100% when they first came out with the bonus in 2017.
It was like that for several years too.
Because of COVID, it got extended. So we got to
Mm-hmm.
really rely on that 100% for quite an extended period of time that wasn't
It's
originally.
like Scrooge McDuck,
Yes.
but instead of a whole warehouse full of gold coins, it was depreciation expense.
Yes, totally what it was.
Doing the backstroke in it.
Yep.
Now we're at 40%, goes down to 20%
Next year.
next year, unless we revive this provision.
Yeah. So that's a big one. And you know, who knows what they would send it back to, because it was 50% before. There's been bonus depreciation available for quite a long time in our tax code. There are periods where it kind of was phased out or whatever, and they've changed it, so on and so forth, but never really to the level of 100% that we saw with the Tax Cut and Jobs Act. So it's significant. There's a lot of talk. I think it's going to be one of the more highly debated things within the code if they if they choose to get something written up here before the end of the year. But that's a big one.
Yeah, and we got to remember, all laws are designed to either encourage or discourage behavior. So if we're giving out bonus depreciation, what is that doing? That's encouraging businesses to buy new equipment, to replace their fleet, and that then in turn boosts manufacturing, things like that. So it was a real big boon for just the economy in general,
It
let alone
works.
a great strategy for individual investors to be able to take advantage of. The last one we've got is the R&D, the research and development expense deduction, R&D.
So what had happened here when we originally put this in, it started allowing for expensive research and development expenses, meaning you could deduct 100% right away, basically. Now, it's not really expiring, but approximately in 2022, they did put a limit on this, and they started requiring that you amortize, which is basically the same thing as depreciation, only with an asset, an expense. So you are taking like 1/5. It's over 15 years, so 1/15 of the amount, or 5 years, depending on it, an equal amount each year until you expense all that. Hopefully, they're going to bring it back to where you can deduct expense that is 100% of it right away, like it was in the beginning of the Tax Cut and Jobs Act. But we'll have to wait and see. That would arguably be another thing that spurred, the investment.
Encourage certain activity.
Exactly, no question about it. And there are people who specialize in that. We work a lot with cost seg. I always call it cost seg authority. It's now CSA. Is that right?
I think in the cost seg association now, maybe?
Yes, same group.
It's the same group.
But they do all the cost seg. That's a very specialized area. Likewise, R&D is very specialized, and so there's groups out there that specialize with research and development, expenses and things like that. And so that clearly started a new level of depreciation, or excuse me, of expensing, and hopefully we'll see that come back too.
All right, those are the big ones. So if these are extended, they don't necessarily have to all be extended. They don't necessarily have to all be extended in the same amount of time. It's going to be individually looked at. So we may see some, we may not see others. Put up in chat which one you think.
What's your favorite?
Yeah, your favorite. Which one you'd be like, yeah, I'm calling my congressperson every day to make sure this is coming back through. Which ones do you not really care about? I personally, for what we do, the bonus depreciation is a big one, especially for our clients there.
Like that, and I'd hate to see us go back to the personal exemption. I'd like to keep the standard deduction.
I do like the standard deduction because every time they ask me at the we have 6 kids, 3 at home now, but every time we go to the pediatrician because of the preschool plague, would you like your receipt? I get to say, no, actually, I'm good. Salt.
And then that
person lives in California, 100%. Bonus depreciation with 3 exclamation points.
Yep. I definitely want to see the estate tax, keep that on there too.
Someone said no idea, so that must mean that we didn't do a good enough job explaining.
Just all of it. Bring it all back.
Bring it all back.
Right?
Overall, did a lot of good for individuals.
We got 1 thumbs up for bring it all back. Yes, all. Right. There you go.
Yeah.
All right. Got that vote.
All right, we're going to wrap it up. Please subscribe to Toby's channel. This is the channel we're live on right now. The recording of this will be available on his YouTube channel. He's got a ton of great videos there, always coming out with new things as well. In addition to Clint Coons, who is our other founding partner, a little more focused on the legal side. But again, tax and asset protection do go hand in hand. That's why we cover both around here. If you want to learn more, if you want to do a bit of a deep dive, come to one of our Saturday webinars. It's tax and it's asset protection in the morning, tax and estate planning in the afternoon. I teach those a couple of times per month. We've got a different rotation of attorneys who teach, who are on in the background answering questions, just like this in the Q&A. We would love to have you as well. If you want to come in for a 3-day live event, conference room style.
Yes.
We've got vendors, we've got giveaways, we've got a lot of excitement. You can leave with a personalized structure and a personalized action plan. Then come on down to our live tax and asset protection event. It's the end of June. It's going to be here in lovely Las Vegas, Nevada. Finally, if you are just at the point where you want to jump in, go ahead and click. Do you click a QR code? Scan the QR code. You scan it.
Yep.
And we can set you up with a strategy session with one of our business advisors. We've got, oh man, that was just the one room that had 450 years of experience.
Yes.
Within Anderson, it's probably triple that.
Yep.
You're going to get set up. They can go over your goals, your aspirations, the things that you're particularly worried about, look at different assets you have. Not all of this is cookie cutter. I know that we answer specific questions and we can say generally you would want to do this, but a lot of times it's super helpful to get on the phone with somebody, talk about what they want to do, talk about what they're concerned about, and get you a customized plan is really what you need. If you have any questions that you'd like to be featured on Tax Tuesday, go ahead and send them to Tax Tuesday at AndersonAdvisors.com. We like to make things really straightforward and
Yes.
easy when we can.
And we review them all.
I don't.
No.
This guy does. This guy reads every single one of them and then compiles, curates, really. He curates like a museum exhibit, curates the list of questions we address each week.
Speaking of questions, thank you all for joining us. We got 179 questions. Our team's been out there. We got, again, Patty running the show. We got Dutch, Jared, Jeffrey, Jennifer, Marie, Rachel, Tanya, and Troy, all of them just clicking away, getting questions. So thank you for our staff. You know, Matthew and Kenny running the show in the behind the scenes.
Yeah, thank you guys so much. And thank you guys for joining us. You're the reason we do this. Send your questions in and see you in 2 weeks on Tax Tuesday. Take care, everyone.